Let's take a look at this budgeting and cash collections problem. It's exercise 8-24. Anthony Inc. is preparing its first quarter monthly cash budget for 2009. And then we have some information appearing for 2008 sales and expected 2009 sales. Tracing collections from prior year monthly sales and discussions with the credit manager helped develop a profile of collection behavior patterns. So of a given month's sales, 40% is typically collected in the month of the sale, and because the terms are 1% end of month net 30, all collections within that month will be net of the 1% discount. Of a given month's sales, 30% is collected in the month following when the sale was made, and the remaining 30% is collected in the second month following the month of the sale. Bad debts are negligible and should be ignored, and we're asked to prepare a schedule of cash collections for January, February, and March, and to calculate accounts receivable balance at March 31st. Okay, so let's drop in what we know. We're going to collect 30% every month thereafter, right? So we pay 40, then 30, then 30, then 30. 40, then 30, and 30, and that would equal 100. So to do January, we've got November sales equal 41,500 times 30%, because we're collecting in January the remaining 30%. Right? So we've got 12,455. Now in December, let me sort of take that away. December sales impact on January would be equal to 38,000, also times 30%. Okay? Now, December sales in January, we've already accounted it for in this area. Now, I really don't know why it's repeated. We really don't need the extra row, but I'll go ahead and use it. We'll take the December sales of 38,000, and in February we're also going to have 30% collected. So we've got 11,400, and really we could have just put that one row up. Okay, January sales, we get 40% during the month we sell it, so 39,500 times 40%. We've got to back off that 1% from the amount. So let's take the 39,500 and multiply it times 99% first, right? Because they're going to take a discount. And we come up with 15,642. Then when we think about what's the impact of January sales in February, now we take the full amount because they've missed the discount. January sales were 39,500 and multiply that times 30%. And I've got 11,850. And then also in the month of March, we're going to have that same 11,850. So why don't I just copy it? It's going to be the same monthly sales times 30%. All right, in February, the month of February, we had 44,000. We've got to do that same calculation again. So we'll take 44,000 times 99%, or 100 minus 1%, right? For the discount that occurs in that month. And then we only collect 40% of that. Okay, this is the pattern we've seen. And then on March, we would have to take the 44,000 from February sales and multiply it times 30%. Okay, and then finally March we have the exact same pattern occurring. We are going to take 29,500 of sales in March times 99%, and then multiply that times 40%. Okay, you can see my formula as I'm entering it. And from there, we've derived the total collections. Okay, next thing we need to do, I'm going to slide this a little bit, is February sales to be collected in April. Well, February sales to be collected in April are going to equal that $44,000. And we're essentially doing the same thing, just taking it into the future now, times 30%. And we would have March sales to be collected in April would equal the $29,500 times 30%. And March sales to be collected in May would be equal the $29,500 times 30%. Okay, and when we're done, we could calculate, I think I entered a minus in there by mistake. Yeah, let me get rid of that minus. So I got 13,288.85, and what we wind up with is the total AR balance at March 31st. And that's all there is to this problem. So it's really a question of interpreting the percentages and when they take place. Okay, so there's our collections. And there's the AR balance at March 31st. Thanks, everyone.